Joining us right now is a guest who has been sounding the alarm on cheap money for some time now. Mark Grant is the chief market strategist of fixed income at B. Riley FBR. And Mark, I think you've probably been talking to us about your concerns and have stayed on message with that for longer than just about anybody I can think about. Last week, we saw $17 trillion is now the number of negative interest rates, sovereign debt around the world. And that skyrocketed pretty quickly. You're still very worried about what this means.
Well, Becky, the high previously was in 2016. It was 12.2 trillion, and it kind of flatlined. In the last 3 or 4 weeks, it went to 13 trillion, 15 trillion, 16 trillion, and now, as of Friday, we're at 17 trillion in negative yielding bonds. And while everybody focuses on China because it's a news event, in my opinion, the far greater problem that far dwarfs what's happening with China is this negative yielding debt.
Why is that?
Well, it makes it a great time for borrowers, and it's going to be a two-step process as interest rates go down, which I think they're going to do regardless of what the Fed does, because you may recall Erasmus's famous comment that the one-eyed man is king in the land of the blind. There is no other positive interest rates virtually across Europe, in Asia, Japan. So we're getting a steady stream of foreign money coming in to buy our bonds because we're the last man standing with positive interest rates. And eventually, in my opinion, we're going to get down to 1%, half of 1%. And then it's going to be create a lot of difficulties, especially for savers, retirees, pension funds, any kind of institution or person that depends on fixed income yields and cash flow to have a decent life.
The equities futures that we're looking at this morning are stronger, and it's probably because it looks like interest rates are firming up this morning. You just don't think that that's a realistic situation that can last?
Becky, I think that regardless of what the Fed does, as I said, we're going to have lower interest rates. I do think the Fed, which is the central bank of the United States, it's part of the U.S. government, founded by the Federal Reserve Act in 1913, has to lower rates so we're competitive with the rest of the world. But this is creating talk about never before, for thousands of years, we've never had negative rates where the lender is paying the borrower, where the borrower for the privilege. It's just ridiculous.
I don't know where this ends, but I do know that if you're looking at where to put your money right now, equities look like a better place because you're not going to get any return if you're trying to put the money in bonds. So couldn't that really help fuel the rally in equities, at least for a while?
Yeah, Becky, I think you're spot on. I think lower interest rates, margin rates, mortgage rates, more refinancing, I think you're spot on. At the first blush, it's going to help all the riskier assets such as real estate or the equity market. At the second blush, or the second stage, when American interest rates get close to zero like the rest of the world, then you're going to see a reversal in that because lower rates at that point aren't going to stimulate risk assets anymore. You're going to reach a point where it's going to flatline, and then I think we're going to see the opposite reaction.
So what do you tell people to do right now?
Well, right now with people, individuals, and I deal with some individuals, I deal mostly, as you know, with big institutions, but I've had the program of corporate bonds, investment grade. I can still get carefully around 4%. And then the other space I really like where you can get yield are closed-end funds, but they're complicated. And I mean complicated, but you can get still double-digit yield. So I put those two together and end up with a nice return, and I think in a very conservative way. And that's what I've been doing for the individuals that I do
Mark,
business with.
Okay, I understand what you're saying in terms of that risk assets become harder to move the needle. It's like pushing on a string. But so let's say you buy Pfizer with a 4% yield or AT&T with a 5.5%, 6% yield. How does that suddenly become an investment where the stock goes down and it goes to 8% yield. So is the economic conditions become so bad that the stocks are sold, or the dividends become more difficult to pay because economic conditions are so bad? I just don't see how, if rates continue to go down, how can blue chips with yields end up being a bad investment?
Joe, they're not a bad investment. I'm saying at the moment, in the first stage.
Well, okay. In the second stage, how do they become a bad investment?
Become a more difficult investment because lower borrowing costs aren't going to drive equities or real estate or anything else as you approach zero. And yes, I think, though, you're right, that stocks with good dividends that are solid companies will continue to have some value.
Either their businesses go south, Mark, or and they're not able to pay their dividends, and the dividends are at risk, or their businesses, their earnings go down so that the multiples go down, and you lose more in the principal of what your investment is than you're making up on the yield, but then the yield's going up, so then you're back to saying whether I don't know, it just seems if you've got a solid company that it's going to be able to cover its dividend, that I don't see how that applies to even your second problem.
Joe, I think that's one decent option. I think you're making a very good point.
Okay.